Good day, my fellow traders. So, today we are back in the charts once again, and today we're going to be simply talking about a simple trading strategy, a simple price action trading strategy. In the markets, forget about indicators, forget about complex systems. What you need in the market, what you really need in the market is a simple trading strategy follow based on price action. Any indicator you're putting in the price is just lagging. It's just going to give you a signal after the price has already moved. So, looking at Euro USD today, I am going to explain a simple trading strategy that if you backtest, you will see profitability from it. So, without further ado, head over into the charts. So, alright. So, this strategy is a trend following strategy. It is a trend following strategy. So, alright, and make sure to bring your notes alongside you to write down what I'm about to tell you, about to say. Yes, it is of very crucial importance. It is of very crucial importance down for the beginner traders so that the information is going to be to your head. Although this video is going to be on YouTube, so you can watch it. Don't forget to like and subscribe, and also leave a comment below in the comment section below in case you have any aspect you want me to upload on YouTube for you guys. Alright, so there are three major types. There are three major movements in the market. One is the bullish trend. One is the bullish trend, is that the market is trending, making higher highs. One is the bullish trend. The bullish trend is a trend that makes higher highs, and higher and higher. Trend is one lower highs and lower lows. Lower highs and lower lows. So for a market and higher lows, for the market to trend down, it should be making lower lows and lower highs. The market is just moving sideways, and it's called a range bound market or a consolidating market. We don't want to be trading in those kind of market conditions because it is not for us. We join the market. So, alright, and one thing I need to tell you about is also time frame alignment. You see, price is fractal. If you've ever gone to the forex chart, you can see that have numerous time frames. If you ever gone to the chart, you can see that there are so many time frames. We will have from the monthly time frame. From the monthly time frame, you have the weekly time frame. From the weekly time frame, going down to the daily time frame, 4-hour time frame, 1 hour time frame, 15, and so on and so forth. So, if if you go to the monthly time frame, you will see that one candlestick closes in the month. The daily time frame, one candlestick closes in the day. So the movement of the daily time frame makes up a monthly time frame in the duration of 1 month. Also, in the weekly time frame, 7 days in a week is equal 1 week. But in forex is it opens on Sunday. It opens on Sunday, and Sunday around I'm currently in Nigeria, so our timing is UTC +1. You can check the timing here. Easily convert. I don't know what's wrong with my system. So we're back. So, all right. I'm currently in Nigeria. As I was saying, I'm currently in Nigeria. Is UTC +1, but currently now it's UTC. That is, UTC is London time. Nigerian time is 1 hour ahead of London time. So the market opens by 10 p.m. Nigerian time, whereas in London time is going to 9 p.m. -1. All right. So, and it ends on Friday, 10 p.m. 10 p.m. Nigerian time, or 9 p.m. London time. So that makes one weekly candle. And you know that, okay, from Sunday to Friday, 10 p.m., you can calculate how many days it is. It makes one weekly candle. So let's say Sunday, from Sunday 10 p.m. The candle is going to close Monday. 1, 2, 3, 5 days. 5 days in a week. So it takes 5 daily candles to make one weekly candle. So what I'm trying to explain this to you is trying to tell you that price is fractal. Price is fractal. The smaller time frame candles, the smaller time frame movements makes the larger time frame candles, but the larger time frame levels and movements are way more stronger than the smaller time frames, because if you start going down the time frames, you will see a lot of noises. But one higher time frame candle is just going to show you a decision. And investors, so in this strategy, we use the higher time frames in confluence with the lower time frames. What I mean is, you use the higher time frame, you choose a time frame that's the higher time frame, then you use a smaller time frame to check the activities to confirm that lower time frame. So, explaining further, time frame alignment, use daily. Please take up your notes right now. This is very important. If you are using the daily time frame as your higher time frame, so the 1 hour time frame is going to be your entry execution time frames. That means you will be using daily time frames for key strong levels, and when the price reaches those levels or hits those levels, you will be going to your 1 hour time frame, which know to find the change of trend, to find what price is doing that particular key level, that's that particular daily key level. Yes, if you're using the H4 as your higher time frame, If you're using the H4 as a higher time frame, then using the 15 minutes time frame for as your smaller time frame. Also, if you're using one as a higher time frame, you have to be using the 5 minutes time frame as your lower time frame. And also, if you're using the 15 minutes as a higher time frame, you have to be using the 1 minute as your lower time frame. So, alright, let's just head down to this example. Assuming that price is just making higher highs, let's go over here. So explaining further, let's go now down into the strategy. Price, you must identify a direction in the market. Look at the chart and see whether price is making higher highs and higher lows. Choose one direction, that is, in this direction it is bullish because price is making higher highs. Price broke above this previous high, signaling to me that price is bullish. So now when price first indication of the strategy is a break of the previous high, or it's called a break of structure, a break of previous high. When you see price has broken your previous high, now this is an indication that this is an indication that this price is bullish. So now there's a break of structure. That is the first indication. Second is a retracement to an area of value. So an area of value can be Fibonacci level of a Fibonacci from this low to high, a 50% within that price leg also is an area of value, is a strong area, is a strong area. Also, for other blocks also, you can see other in confluence with the 50% Fibonacci level, or under the 50% Fibonacci level. I'll be talking more of other blocks and supply and demand zones so that you understand the good key levels to take a trade from. So once you wait for price to retrace towards the 50% Fibonacci level and also supply and demand on another block. So these zones and price indicate that there is going to be a demand zone, there's going to be buyers there. An order block, a bullish order block, there's going to be buyers there. Assuming this is a higher time frame, let's just take this as H1 is your higher time. You see H1 just goes down and hits an area of value. This is the higher time frame. Then you scale once it hits the higher time frame level. That is, once it hits H1 level, I wait for a rejection candlestick in still the same time frame. That is the higher time frame. That's the higher time frame. Yeah, that is the H1, the higher time frame candle rejection. So once I see that candle rejection, I see a pin bar, I see a bullish engulfing candlestick, I now scale down to my 5 minutes time frame to dissect that rejection candle. So once I dissect the rejection candle, I want to see, as in this phase in price, this retracement, this retracement is just going to be opposite of the bullish retracement. It's just going to be making lower lows and lower highs. But once it hits this key area of value of the higher time frame, you will see a change of character from bearish to bullish. Then this is now signaling to you that, okay, yes, at this point in price, the bullish now are entering back into the market and I want to be involved. Now it broke the previous high. Once it breaks this high, I'm entering the trade. I'm entering the trade with my stop loss below here. I might take profit. What's wrong with this now? Alright, with my stop loss below here, with my stop loss below here, my take profit is going to be at these highs, or you can decide to push a little bit forward. Yes, all depends on just take price. You just make your take profit at the previous levels, to take your profit. So that is about this video today. Please leave a like and also leave your comments in the comment section below so that I will know what to post for you guys to enlighten you guys. Remember, this is an educational channel. I am going to give you top-notch education because I have spent a while in this market and I know I am not going to deceive you on anything. All the things I say, you just need to go and make your research and back test. Go and back test the strategy. You wait for a break of structure first. After a break of structure, that is after price breaking. After price breaking this previous high, you wait for a retracement into an area of value. An area of value can be a 50% Fibonacci retracement. It can be a demand and supply on an order block. Then you wait for, if you're using the H1 as a higher time frame, you wait for a candlestick rejection. Then you scale down to your 5 minutes time frame to know what that candlestick rejection is talking about. If you see, if price breaks the high, you can also wait for the retracement and take your entries, or you can wait at the break off. You can still take at the break off of the previous high in your smaller time frame. Then place your targets and finish. You just wait for the trade to play out. It's as simple as that. So thank you guys. Have a lovely day.